Hi, everyone, and welcome back to the Client Classroom. We're halfway through 2025, and if you're feeling like this year has been a roller coaster in the markets, you're not alone. Today, I want to walk you through where things stand, what the experts are saying, and more importantly, how you can stay grounded and make smart decisions even when the headlines are anything but calm. Let's start with a quick recap. Equity markets started strong this year, riding a wave of optimism around AI, cooling inflation, and expectations for rate cuts. But as we moved into the second quarter, the narrative shifted. Geopolitical tensions in the Middle East and Eastern Europe flared up again, oil prices spiked, and central banks, particularly the Fed, became more cautious. The S&P 500 is still in positive territory for the year, up around 8% as of mid-June, but volatility has returned. According to JPMorgan, earnings growth is moderating and equity valuations are starting to feel stretched. Meanwhile, Goldman Sachs notes that U.S. economic data has been resilient but not bulletproof. On the bond side, yields have stayed higher for longer than many anticipated. The 10-year Treasury is hovering around 4.5%, reflecting a tug-of-war between sticky inflation and slower growth expectations. Overseas, the European Central Bank just made its first rate cut, while emerging markets are facing pressure from a strong dollar and shifting trade dynamics. Now, depending on who you listen to, the second half of 2025 could go in a few different directions. Bank of America sees room for stocks to rise further, especially if the Fed pivots and corporate earnings hold up. Morgan Stanley, on the other hand, warns that markets may be underestimating risks, particularly if inflation stays sticky and rate cuts get pushed into 2026. UBS is somewhere in the middle, advising clients to stay invested but selective, focusing on quality companies and diversified global exposure. So who's right? The truth is, no one knows exactly how the second half will play out, and that's why a long-term disciplined approach is so important. And this brings me to something we see all the time: emotionally driven investment decisions. When markets get choppy, it's tempting to jump ship or chase returns, but multiple studies have shown that this often backfires. For example, a Dalbar study found that the average investor underperformed the S&P 500 by more than 6% annually over a 20-year period, largely because of poor timing decisions. The takeaway? It's not just what you invest in, it's how you behave when markets move. So what can you do? Stick to your plan. It's designed to weather both good times and bad. Rebalance with intention, not emotion. Sometimes the best move is to do nothing at all. Keep cash reserves for short-term needs so you don't have to sell investments at the wrong time. Tune out the noise. Headline risk is not the same as portfolio risk. And if something's changed in your life, or you just want to talk it through, that's what we're here for. Let's schedule time to review. I hope this gave you some clarity and confidence as we head into the second half of the year. As always, don't hesitate to reach out with questions. Thanks for tuning in, and we'll see you next time in the Client Classroom.